Welcome to Life Isn't Lived on a Spreadsheet with Ryan Poterack from Poterack Capital Advisory. You have unique values, objectives, fears, life experiences, and biases. Any financial professional who ignores or minimizes the importance of your story may not be able to help you achieve your ideal outcomes or hit your goals. It's time to experience the PCA difference. In this podcast, we help business executives, soon-to-be retirees, and solutions-based individuals overcome the anxiety leading up to their upcoming years. We do this by initiating in-depth discussions about the financial aspects of retirement, like tax planning and asset allocation, alongside, and often overlooked, personal and lifestyle aspects. Join us for this journey where we explore retirement from a contrarian point of view, as Ryan draws from years of experience and qualified guest professionals to help you explore the true purpose of your money in retirement and the impact you want to make in your golden years. Ryan Poterack and Alec Quaid offer investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Private Advisor Group and Poterack Capital Advisory are separate entities. This information is not intended to be a substitute for individualized legal or tax advice. Please consult your legal or tax advisor regarding your specific situation.
You may have heard the mantra, invest for the long term. Well, it sounds easy, but when the markets are jumping around, you may get antsy yourself and want to start making changes to your investments. May I suggest you don't do anything? Not until you listen to Ryan Poterack, a seasoned wealth manager who has a lot of experience to share. Ryan, what can you say about timing the market?
Hi, Patrice. How are you today?
Doing well.
Well, there's an old saying that it goes something like this. It's time in the market, not the market timing, because particularly in the short term, now there's such a wide array of investments that may operate very differently in different economic conditions, but the shorter the time frame, the more almost arbitrary or unpredictable the results can be. So when we look at past performance, which guarantees nothing in the future, but we do see over decades with any particular investment class, all of the anomalies in the short term, difficult months, quarters, difficult years, wars, things like that. It all tends to kind of get consistent over a long-term view when you're looking backward. But that's over a long period of time. What kind of, especially I think in the last couple of decades with social media, the nature of the news and the people that bring the news to us, it's just gotten so emotional. And so with the headlines and the noise, and I know this going into a presidential election year, because I've been through a few of them, I already have clients saying, well, I want to do this or I want to do that prior to the election or after the election, even though in my view, as a professional that's been in this industry for 34 years, that's just noise. There's absolutely no reason to think that a year in which there's a presidential election is good or bad for your investment. So typically the market timing is emotion driven. It's not something that professionals spend much time at all looking at.
Well, Ryan, how do you feel about somebody saying, well, I know when the market's going to go up and I'm going to put my money in and I'm going to get the big days?
Well, my first reaction is they're a fool. They might be a lucky fool, but nobody can predict the future. The thing about market timing is you generally have to get lucky twice. So let's say that you're currently invested in the market or whatever, and you believe that now is the time to get out. So you sell whatever the investment is, and let's say that it actually plays out. Let's say that the market after you get out goes down. So you got lucky once, but now you're on the sidelines in cash and you have to get lucky a second time as to, okay, when do I go back in? And, usually people think that the timing is right to get out of the market because they think they have a crystal ball that bad things are coming. But then if bad things actually come and they feel good about it, so they don't tend to get back in the market though until it's all good again. In other words, they missed the recovery. when we go back 100 years with the market, the one thing that we know is that every time the market turned down, ultimately it not only recovered, but reached new highs. I mean, the history, which guarantees nothing in the future, the history is clear that the market in the past for 100 years has gone, the graph goes from the lower left-hand corner to the upper right-hand corner if you were to graph it. So I think that it's one thing to get lucky one time, but if you get out of the market and you have, and this is long-term money in particular, and now you're in cash, that's when do you get back in?
Yeah.
And it is really, I've also put it this way. I suppose many people in our audience at one time or another has gambled in some form. And if you were to take 1,000 random people in Las Vegas and give them all $1,000, and in those 1,000 people, there were people who were grizzled experts in poker or whatever, and then there were just complete neophytes that barely could spell gambling. But if you took that 1,000 people and gave them each $1,000 and said, go gamble your heart out today, at the end of the day, you'd have a bell curve in terms of performance. You'd have experienced gamblers that were unlucky and were on the left side of that bell curve. In other words, they performed horribly. And you'd have people that barely gambled in their life that just got lucky. Maybe the one-arm bandit, or they put a black 25 and the roulette wheel just came up that. And so investing is not gambling, but the emotion of investing, particularly for amateurs and do-it-yourselfers, is very akin to that. And so I think that there are some people that it's kind of a confirmation bias with regards to market timing. But in the end, that's why there's a lot of lights in Las Vegas, because in the end, Las Vegas wins. And I would suggest anybody that thinks they're a market timer, it may work, they may get lucky, but it's not a long-term strategy.
No, I totally understand what you're saying. You see the market starting to go up, but by the time you move and get your orders in, you're behind the curve.
Yeah, there's some interesting studies where even over a long period of time, maybe 20 years, where if you would have missed out on a relatively small number of days, I don't have this precise off the top of my head, but it might leak, if you miss the 10 best days or the 15 best days over a number of years, it makes a dramatic difference in the rate of return. And certainly while you can't predict the market of, what it's going to do the next 3 to 5 years, a year, even a month, but you sure as heck can't predict it on a day-to-day basis. And so that's all talking about past performance and history, but history is a guide. If you are open to it, it will teach you some lessons about how you might behave in the future to hopefully have better success.
How about someone who says, but Ryan, I'm diversified and I know what I'm doing here. I'm doing just fine and I can play over here. I can play over there. What do you say to them?
Well, there's quite a bit there, Patrice. Anytime somebody says that I'm doing just fine, well, what is fine? I mean, I get it. It's an adjective, but what does it mean to that person? Or maybe they say, well, I'm doing well. I'm doing good. I think proper English is probably doing well. But anyway, well compared to what? See, the thing about do-it-yourselfers is they typically don't compare their performance. They don't grade themselves on a curve relative to anything, but also the diversification. People might tend to sort to a phrase, I don't want all of my, eggs in one basket.
Eggs in one basket, right.
But diversification from an investment standpoint is not simply having a lot of investments or a lot of accounts. It's having a variety of investments that react differently under different market conditions. So and we see this a lot, we call it, or it's referred to typically as overlap in the industry, where when we do a deep dive, kind of an audit of prospective clients' existing accounts, they may have, just as an example, they may have 10 different mutual funds, and maybe 5 of those mutual funds substantially own the same stocks or the same securities. And so not only, and that's what we call overlap, is when you have multiple funds that own the same securities, and a lot of times the client doesn't recognize, they'll just buy ABC mutual fund, they'll feel good about it, and then they'll buy XYZ mutual fund, they'll feel good about it. But those are each one line item on a statement. They don't really know what's inside. We do an audit to determine that. But if they tend to, if the investments that a client owns in their household all tend to be correlated, meaning they all go up in concert somewhat, or they all go down, that's not diversification. Diversification as a strategy, and also, again, diversification doesn't guarantee results in the future, but the nature of the strategy is to smooth out the extreme peaks and valleys. That's why somebody would want to diversify, is to have kind of a smoother ride instead of a wild roller coaster. But unless you have various investments that are uncorrelated, and a very simple example would be just the good old stock and bond. So if the stock market's going up, investors get excited about the stock market, and they might tend to out of bonds because bonds are just kind of drifting along at a certain low rate. But however, when the stock market goes down, people get scared and they sell the stocks, and then they have to they choose to do something with the cash, and they tend to put it in conservative investments like bonds. My point being is, if the stock market goes down, there's more demand usually for bonds. So bonds can be doing well in a down stock market. So if a portfolio, and I'm just talking about two investments, but if you had 50% stocks and 50% bonds, for sure, historically, that's going to be a smoother ride along the way than if you had 50% in ABC stock fund and 50% in another stock fund, both of which rise and fall with the overall market. So the diversification is, well, I guess I bring critical thinking to just about everything. And a lot of times there's a false sense of security and or confidence in a do-it-yourselfer's portfolio if they just own a lot of different investments by title or label, instead of really understanding what they own.
Right. And along those lines, talk to me about sticking with proven investments, stocks, bonds, or looking at AI, crypto, non-fungible tokens, which, to be honest, I still don't get why people like those. But what are your thoughts there?
Well, the NFTs to start on the back end, that might already be a fad that passed, because you don't hear, about 2 years ago, you heard a lot about it. Yeah. But well, first of all, with you using the word proven. So proven would be looking at the past performance of particular investments. And so you have, in the world of stocks, if you ask, a number of people on the street, hey, what's a good company to buy stock in? They might say Amazon or Apple, because those companies have had a tangible effect on just about every American. And also the stocks have done very well. However, to call them proven really would depend on when somebody was invested in those stocks, because both of them got hammered in 2022, for example. So they've had a wild ride. So with proven investments, I don't know that you could really say there are proven investments. However, if there is time spent on it, for me, it all starts with, what is the purpose for this chunk of money or account? It all starts with what the client is trying to achieve. So they have an objective. It's retirement. It's buy a bigger house. It's send their kids to college. Whatever the objective is, then the next layer, and a somewhat simple example here, is, okay, well, what is the approximate time frame to achieve that objective? Well, if it's a longer, by long, at least 5+ years, that would be very different than, well, we want to buy a larger house in the next 18 months. I mean, right there would start to determine, the time frame starts to determine, well, what investment should we use? What level of risk that we use? And then you also have the qualitative aspect of the prospective client I'm talking to, or the couple. What is their comfort level with risk? Because generically, the industry will say, well, if you're young, like you and Patrice, or Patrice, you and I, they'll say, oh, well, you're young, you've got a lot of years, so take a lot of risk. But there are people that just aren't comfortable with that. I mean, I know 30-year-olds that have investments, and they don't want that volatility. And so I think sometimes in the larger industry, or from an academic standpoint, the definition of words like proven or not and other adjectives can mean different things to different people. So I always come back to, Patrice, the questioning, the number of questions we ask, and the listening gets to, well, what does proven mean to Patrice? Because I could be talking to one person who's had long-term success in the stock market, which historically has happened long-term.
Mm-hmm.
What's long-term? I'd say probably 10 plus years. So if we look back at the stock market over a long period of time, I think it's fair for an individual to say, well, it's proven that the stock market is a good place to have your money long-term. I'd say that that's essentially a fact, or from a consumer to say that would be a fact. Now, then to conflate that with, hey, I just inherited $250,000, let's say, and so I'm going to put it in the stock market because it's proven, so that when my high school senior goes to college in 6 months, that we're going to be in a better position. So I think that's what you get into with terminology and what's proven. So to me, it's really a dialogue. It's a question and answer. It's education to help a client understand. They don't need to understand in the weeds, but that myself and the client or the couple, we have an equal understanding of what are we trying to achieve. And then we can discuss, okay, there's various investments and strategies that might add to you getting to your objective. In the end, it tends to be somewhat of a symphony of different instruments and strategies, because again, the diversification is somewhat of a defensive strategy, as opposed to, hey, I'm going to put all my chips on one particular investment, and then you might get lucky, but you also might have your hopes dashed.
Well, in that orchestra, is there room for the next big thing?
I think so. I mean, it's all a matter of degree. I have a sweet tooth, so I love a lot of desserts, but I'm also disciplined. I allow myself to have an extra glass of wine or a dessert now and again when I'm out to dinner, and I think that that's relatable. So, okay, cryptocurrency's been talked about a lot certainly over the last 5, 6, 7 years. And I've got no problem if a client discusses that with me and they say, okay, well, what do you think, Ryan, if I put 1 to maybe 5% in something like that is highly speculative, very volatile, but if it's a small dosage, it's not going to sink the entire investment ship if it goes in the tank. And it, when we look at the history of crypto, when we look at the history of anything, we've got facts. And certainly in the history of its growth, it's had phenomenal growth. Now, that doesn't promise anything in the future. So I think it's a matter of I'll go back to Las Vegas. I don't know why it's on my mind today, Patrice. But when you go to Las Vegas, do you take all of your money?
I sincerely hope not.
No. You don't mortgage the house and take everything. You just take a certain amount. You have the hope to win, but if you lose, the amount that you would lose in Las Vegas or in crypto should not be such that it completely tanks your overall plan towards your objectives. So I find my role, first of all, typically if that comes up, crypto and some of these other more recent investment alternatives, it usually comes up not from me. It usually comes up from the client. They're hearing the buzz, or they have friends that say that, all the great things that are going on when it's going up, and then they're kind of quiet when it's going down. But nonetheless, I see my role as putting in perspective for that client, somewhat as I've done over the last couple of minutes with you, Patrice, is sure, it may do great, but we don't want to have an inordinate amount invested in it, because that is a wild ride. Mm-hmm. And I've had that happen over the last 5 years. I had a number of clients when crypto is hot. That's when I get the questions. Hey, can we invest in crypto? I said, well, not directly. With all of the major firms out there and custodians, Schwab, Fidelity, doesn't matter. You can't buy any cryptocurrency directly. There are exchange traded funds. This was just recently approved within the last year, so they can buy a fund that the rate of return is linked to a particular cryptocurrency, just to be clear with our audience, but it is a wild ride.
Yeah. Wild rides lead me to this question. In your experience, do people appear to learn from their mistakes?
Depends sometimes on how big of a mistake it is. It can also, there's so much in the news these days about gender, et cetera. And the reason I go there is because I will tell you from experience that if the decisions are joint between, let's say it's a couple, it's a husband and wife, by far men take more risks than women. This has been, we've seen this in study after study. And if a husband makes a mistake and didn't involve his wife, it's a whole different dynamic. I think that if in that example as a couple, sometimes it might be the one, okay, there's a mistake, and then the mistake becomes apparent to both. And then that lesson sticks. Lesson sticks. So it depends on how big of a mistake it is with dollars and cents, but people have short memories. Like 2022 was a very difficult investing environment. S&P 500 was down in the ballpark of 18 to 20%. But as soon as that turned around towards the end of 2022, throughout 2023 for the S&P 500, which was up a similar amount that it was down in 2022, they forget about that. When things are going good, they forget about the fact that the market can reverse itself very quickly. And it's one of the reasons why we do virtual events monthly with our clients is education, education, education. And what that does, or what I've seen it do with the clients and the families that we serve, is when the market is going through a difficult time, they don't get scared and bail out, which allows for that potential recovery. And at the same time, when the market's going great, I would like to think they have a more sober, reasoned view over time. So I would like to think that we're educating and affecting less mistakes. But one of the early questions I ask with a prospective client is I'll ask, what have been some of your biggest financial mistakes?
Mm-hmm.
And that can be kind of interesting, but what I get from it is what did they actually do? And then how do they characterize it in their communication, and what's their mindset around that? So if they learn something from a mistake before it could be many years before we even met, it gives me a sense of how they would respond to the question you just asked me. Do they look at mistakes, which a mistake is something that already happened. That is the past. It can't be a mistake in advance. Mm-hmm. A mistake is a mistake when you find out it's a mistake and you can't go back in time. So do they seek the silver lining of, as you ask about, what did I learn from that and how am I going to apply that tomorrow? And that's, in my life, that's what I'm always looking at. Nobody likes to screw up, make mistakes, financial mistakes or relationship mistakes, but I believe there's a silver lining in every mistake. And so that's the culture that I've sought to foster with my team at Poterack Capital Advisory, and then also with the clients and couples that we serve.
I think that's a great place to wrap this up. That's a wonderful thought. Look for that silver lining. So how can people reach you, Ryan, and if they want to talk about these silver linings?
Well, they can always go to our website, which is www.poterack, that's POTERACK.net. We're out there on LinkedIn, Facebook, and Twitter. They can always call one of our, I don't know the 800 number, but 704-366-5776. Every once in a while, Patrice, I think about, there really isn't long distance anymore. You and I remember that, but there's very few landlines and there really isn't long distance. But yeah, poterack.net. They can reach out. They can listen to these podcasts, which are on our website, and all the past podcasts. I write a blog as well. So there's plenty of information out there.
All right, listeners, follow this podcast. Life Isn't Lived on a Spreadsheet, for information and for insights into investing and wealth management, and share it with others. I'm Patrice Sikora, and thanks for being with us.
Thank you for listening to Life Isn't Lived on a Spreadsheet. Click the follow button to be notified when new episodes become available. To ask questions about topics covered during the show or get a copy of Making It Count, Life Isn't Lived on a Spreadsheet by Ryan Poterack, visit www.poterack.net or give us a call at 704-366-5776. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Poterack Capital Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Poterack Capital Advisory does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Nothing contained herein is to be considered a solicitation, research material, an investment recommendation, or advice of any kind. The information contained herein may contain information that is subject to change without notice. Any investments or strategies referenced herein do not take into account the investment objectives, financial situation, or particular needs of any specific person.
Product sustainability must be independently determined for each individual investor. Poterack Capital Advisory explicitly disclaims any responsibility for product suitability or suitability determinations related to individual investors.